All right, let's start. Thank you very much for joining another edition of Into the Blog webinars series, where we try to cover some of the hottest and most interesting topics at the intersection of data science and in the crypto space. Today, we are going to discuss a very polemic topic, a very polemic analysis about why most quant strategies driven by machine learning in the crypto space fail. This is related to some work I recently published at CoinDesk that it was both very popular and very polemic, and we certainly want to drill down into some of the specifics. As a reminder of the logistics, we try to keep these webinars in half an hour, so we're gonna go very fast. And if you have any questions throughout the session, please feel free to use the Q&A pane. Either there are people from my team that are actively monitoring it, and I will stop several times during the session to take questions. If you don't know me, my name is Jesus Rodriguez. I'm the co-founder and CEO of Into the Blog, and I'm more than anything a data science and artificial intelligence sort of fanatic. So we're gonna discuss go in depth into several aspects of that intersection of machine learning and crypto quant strategies and what makes it very vulnerable to some of the specific dynamics of the crypto space. So the agenda is super simple. So we're gonna look into the crypto quant ML strategies ecosystem and discuss some of the myth and reality, and give you 10 reasons why we think and what we have experienced that most crypto ML quant strategies sort of fail, and some solutions to deal with this. As you know, if you're familiar with Into the Blog, we have an entire division that uses that works with quant desk building trading strategies powered by deep neural networks and advanced deep learning models. So a lot of what you're gonna see is based on practical experience. There is very little theoretical aspects of it. It's all based on a lot of the things that we have learned while building this type of systems. Before we start, I want to give you the usual 30-second update about Into the Blog. In the last 3 weeks since we did the webinar, we announced some very exciting and new integrations. Just today, Into the Blog analytics are powered present at the blog analytics dashboard. We're psyched about this partnership. We have a lot of respect for Mike and Larry and the team over there, and we're really happy to be working with them. A few days ago, the team from Infinito Wallet, very popular wallet, launched Into the Blog analytics in their mobile experience. 2 news portals, Crypto 24/7 and BTC Magazine, recently launched as well in emerging markets like Latin America and Turkey, so that we continue to do well in emerging market. As you know, a few weeks ago, we reported that we have crossed 100 customers, and we have added quite a few in the last few weeks. So we continue to execute very well, and I'm happy with the results. In the next few weeks, these are some of the things that you're gonna see from Into the Blog. We're gonna launch a new set of analytics. This is very, very cool. About crypto, with the whole momentum in crypto, we're gonna launch analytics about crypto versus traditional market. So you're gonna see things about Bitcoin versus fan stocks versus Tesla versus different market indices, returns, correlations, variances, things like that for renewable energy stock, pharmaceutical stocks, everything that has been moving with COVID. And just as a complement of the crypto-centric analytics that we have today, we're gonna be launching that, and we have a big announcement of a partnership in that area in the next few weeks, so stay tuned for that. Also, in a few days, we're gonna unveil this thing called the resource portal, in which you're gonna see a ton of documentation and explanation of every single one of our indicators. It's over 120 indicators. This was a monstrous work that one of our analysts, Lucas Otomoro, took over. And I mean, there is I don't know how many pages of writing in that thing, but it has been a request of our customer base for months, and I'm very happy to bring this to fruition. And then we're gonna announce, we're gonna unveil social sharing, so you're gonna be able to share some of the ITB signals in social networks, as well as download the data. This has been a lot of requests, a very long request in our queue. We keep it, or D5 release has been extremely well received. So it has become one of the most popular DeFi properties in the market. So we're going to continue adding analytics for protocols like Balancer and Aave. And there is, you're already seeing some UI improvements. The site is loading way faster. So we took some time this quarter to optimize in some of those things. So let's start with the session today about crypto quant strategies and machine learning driven, and myth and realities on this. As I mentioned before, part of this work was published in CoinDesk recently. It was a very popular article, also very polemic. I mean, there is even another person who wrote sort of a rebuttal of the article that I don't think it was very related to what we wrote about. But the point of this article was to outline like 10 fundamental reasons, challenges for making quant strategies powered by machine learning a reality in the crypto space. So just to clarify, what this doesn't mean is that all crypto quant strategies fail. Not at all. Like we're working in a bunch of them, and they're successful. And obviously, it also doesn't mean that crypto quant ML models are doomed. Quite the opposite. There is a ton of opportunity for crypto, sort of the ideal asset class for this type of models, or also doesn't mean that machine learning models don't work in crypto. Quite the opposite. That's what we do every single day. So on quite the opposite, quant machine learning is the future of crypto trading. Like if we fast forward a few years, we think investment is gonna shift from completely discretionary to quant. Crypto is a completely digital asset class. We're living in the golden era of machine learning. So this is just going to happen. But right now, there are very tangible challenges in order to make that promise a reality. So many traders are attracted to quant strategies in the crypto space. It's far from trivial to actually make it work. So we sort of joke that when you think about this, many people believe that you're just going to inject a lot of data set, process it with machine learning models, and money is going to fall in over the sky. And there is a lot of myth around this, right? A lot of people making some grandiose claims that are really not correlated neither with the state of the art of machine learning and deep learning or quant finance, nor with the realities of the crypto space. So what I really want to do in the next 10-15 minutes of the presentation is to cover 10 reasons why most crypto quant strategies related to machine learning are prone to failure. And I also want to offer some solutions, which is something I didn't do in the article. So I want to offer some ideas and some solutions about how to overcome some of those challenges. As I said, feel free to use the Q&A panel during the session, and I will stop for questions. So these lessons are completely based on practical experience. There is very little theoretical aspects of this analysis here. It's all been based on things that we have experienced, that we have seen, and that we have had to deal with. And as a result, we're missing quite a bit, right? These are the ones that we have been able to see. So reason number one why crypto quant strategies fail: small data set. So crypto is an 11-year-old asset class. So the longest data set that you have is 11-year-old. If you go to exchanges and try to use data sets for trades and order books, you're talking about 6-7-year-old. Maybe it's a little bit longer with exchanges like Bitstamp. That's nothing from the data perspective. If you compare with models that could build against things like the S&P 500 or the Nasdaq indices that have decades of existence. So in the crypto space, what makes it different is data sets are very, very small compared to traditional capital markets. What that means is that you can take a model that has been, documented, published, validated, that works against derivatives in a traditional market, and then you try to extrapolate that to options or futures in any crypto exchange, and it just doesn't work. There is not enough data for, we're talking about machine learning models, right? Not a statistical models or things like that, for those models to build any knowledge. That equation becomes even more difficult if you were talking about high quality data sets, which we're going to discuss in a little bit. So the availability of high quality data sets is very, very bad in terms of crypto. So I'll give you a practical example. One of the things that we recently tried to do was to build a predictive model for Chainlink based on price. And when you look at the trading history of Chainlink, at the time it was about a year. So you have 12 months to build, 12 months of trading history to build a model. That's really, that's very little. So we had to play with some very aggressive deep learning techniques to try to overcome that challenge. So some suggestions that we have in this area are things such as trying techniques that don't require very large data sets. So there are areas of deep learning such as semi-supervised learning, self-supervised learning. They're very new, but are designed to try to operate in a smaller data set. One of the things that we have tried is to use models such as generative techniques such as generative models to generate synthetic data that looks like the real data, and you can train models and build models that are very specific for crypto. One thing that you're going to encounter is that most quant research doesn't apply to crypto, and that's just general across the board, because crypto is a very, very specific asset class. So challenge number two, because we're really bad at marketing. One of the, I failed to come up with a better term for this, so I call it regular outlier events, which regular and outlier should not be used in the same sentence. But what I'm trying to say is, if you look at a typical asset class, let's take commodities. For something to happen, a super outlier event to happen, it happens once in a blue moon, like the oil futures dropping to negative rates a few months ago. I mean, that happened a few months ago, and it's unlikely to happen in the near future in crypto. So if you have a model there and something like that happen, well, you have some time to retrain the model and sort of decide whether you want to incorporate that data or not. In crypto, this is every week, right? You have crashes and spikes and things going crazy in terms of volume. So you're training for some behavior, and the next week you're seeing a different behavior, and you need to deal with that and sort of recover on the fly and try to incorporate that knowledge and try to determine whether that knowledge is positive, right? Whether those events could become positive knowledge for your model or could introduce noise. So it's a ton of challenges. So some ideas here that we're experimenting with is you need to play with models that work well, what is called with imperfect information on uncertainty. So the techniques such as reinforcement learning, they're notorious for doing this well. Obviously, most RL techniques in capital markets have failed, so this is an area of research and experimentation. But the idea of using uncertainty to models that could operate well in things that change all the time. Think about self-driving cars, right? It's a good analogy. Models that work well in those scenarios could be extrapolated to a new asset class, an inefficient asset class, such as crypto. Also, you can build models that are aware of uncertainty, even if they don't know how to operate against uncertainty. They can determine, their techniques that will allow you to determine whether you're seeing something that you haven't seen before. And then as a risk mitigation strategy, even if you don't know what to do, you can choose to stop. And one of my good friends always say, taking no action is an action. So it's a good approach to be uncertainty aware in certain scenarios, and then always try to create multiple versions. You're gonna see this advice throughout the presentation, right? Multiple versions of the same model, so if something doesn't work, you can roll back and things like that. Reason number 3 that we find that why most crypto ML strategies fail: propensity to overfit. In machine learning, overfit is this term that is used to describe the idea that you train a model on a data set and the model just optimizes for what is in that training data set, but then when you test it against other data sets, it doesn't perform because it's completely optimized for that data set, because the data sets in crypto, they're so small and they're so bad, and quants are under pressure to produce results all the time. You find a propensity to overfit and to come up with models that are very tailored to a specific training data set, but when you put it in the real market, they don't work. This is particularly bad in crypto because the market is so dynamic and it changes all the time. So be aware of models that perform very well on the lab, but the minute you put it in production, they completely fail. I will give you an anecdote. We recently had a model, I cannot describe details, on the DeFi side, and we super tested this from beginning to end. And literally the first few minutes that we put it in production, the performance dropped drastically. And it was because of a condition of tokens that it was using some tokens in some trades that changed the market cap, the circulating supply dynamically, and we never accounted for that. So we literally had to go back, develop some heuristics to account for that, put it, and if you see the chart, the first test was like this and drop, and the second test started like this and a spike immediately. So it was something that we didn't see before. So some techniques that you can apply is invest in a lot of live testing and back testing mechanism specific to detect overfitting behavior. So there are techniques such as early stopping methods, regularization, that are good for this type of approaches. Be strict. The 2 metrics that always describe overfitting in machine learning models, there are many, right? But the 2 classic ones are bias and variance. So bias is this condition in which you predict the same thing all the time, right? And variance is that you're all over the place, right? And they're both bad. So you account and try to measure those things regularly. And again, versioning is important. So if you're gonna train a new model, then keep an old version so you can roll back all the time if something doesn't work well. So complementing this point, there is something that we sort of call the regular retraining dilemma. That is something that we never seen. I spent years of my life building quant systems in traditional markets, and this is a phenomenon that is not very common in traditional finance. That is due to the inefficiencies of crypto. So imagine that you have a model for I'll give you a few examples. So the March crash. So you have a model that have been training Bitcoin. We had it, and the Bitcoin drops 30% in a few hours. So what do? Or a weeks go by of no volatility in May or June, and then recently spike. Or so weeks of no volatility whatsoever, followed by a crazy spike. Or what we're seeing now, that we're breaking new highs almost every day. So because these events happen very regularly, when you face with one of those events that your model hasn't seen before, it's likely that the performance of your model will decay, right? But then the question is, what do? If you do nothing, you are taking the risk that the model will continue failing and you're taking losses. But if you incorporate that data, then you're propense to overfit, because that's the last data. Suppose that we're in March and the crash just happened 2 hours ago, and you take that data and retrain the model. How do you know it's correct? Right? Because you just use the last data set, the last few hours to train the model. So chances are that it's that completely overfitted for that behavior. So this is very, very, very tricky. And it's something that, what data do you use and when? So typically we use some techniques, things like shuffling, that shuffle a data set and use some for training, some for testing, and it's very complicated. But this is a behavior that you don't see in traditional markets. So shuffling techniques are good. Here again, versioning, super important. I sound like a broken record. And consider this methodology for retraining a model. So 3 vectors, right? Either the performance of the model drops, there is an outlier event that you want to capture. Even if the model performed well, you want to incorporate that model, or time, right? The model hasn't been retrained in a long time. So a combination of those is the criteria you need to use to retrain a crypto quant strategy. Then reason number 5, data quality and reliability. So one thing again that happens in crypto that is not very common in capital markets. I was just having the conversation with with a friend of mine who is a CEO of another crypto company, and he was telling me, did you ever experience this in capital markets? And I said, no. Like, typically exchange data sets and all that, they don't go down. I mean, you hear the Robinhood experiences, but nobody's really using Robinhood as a data set. The data sets that you use in quant models, they're very stable. They don't fail. And in crypto, if you're connected to exchanges and all that, they fail regularly. Like two few days ago, Coinbase was down for a few hours, and sometimes they don't even tell you. So and then you have data sets particularly from many exchanges that are plugged with back data, wash traded, fake volumes, fake trades, and all that. And so if you train a model on that, is gonna learn nothing, right? Relevant. But then if you train a model, even if you train a model in good data and the providers go down, then you have gaps that the models get completely confused. And this is an infrastructure thing that is really hard to account. Is a byproduct of the immaturity of the infrastructure still, right? So we have to work more on that. So some ideas that some rules that we typically follow are things like rely on trusted exchanges. So databases from Bitstamp, Coinbase, exchanges that are good and they're clean. And then account for things that are going to fail. So assume that failure is a feature, not a bug, right? Assume that things are going to go down and that your connection to BitMEX or Coinbase is just going to fail, and you're going to have to deal with those conditions. But it's just hard. Like, if your model doesn't see trades, doesn't see orders, it might assume that volumes went completely down and make some stupid predictions. So one thing that we have done after dealing with this many times is we train our models on detecting anomalies. So if you see that there are a number of seconds and nothing is happening, well, that's not normal. So it might be a symptom of a failure, or have infrastructure checkpoints that are retrofitting the model and saying, hey, this is bad, so let's just stop, and things like that you typically need to incorporate. But again, now your quants need to be bothered with this stuff, your machine learning engineers, which is not something that you typically deal with in traditional capital markets. Then reason number 6 has to do with anonymity in blockchains. Obviously, most blockchains are semi-anonymous or anonymous. By definition, what that really means is that you're looking at a uniform data set of transactions and addresses and blocks, right? And whether those transactions and addresses represent Binance or my wallet is the same, right? Like, you're not seeing any difference, and as a result, it's very difficult to extrapolate meaningful semantics or domain knowledge that you can incorporate into your models. So whether blockchain data contains alpha or not remains to be seen, right? Like, we're trying with some very aggressive data sets with mixed results, and we really haven't seen anything particularly promising in the space or research yet. So what's our advice here? The things that we have learned. So we have built a ton of machine learning classifiers that are trying to de-anonymize records. So they tell you, this is a miner, this is an exchange, this is a deposit address of an exchange, this is a cold wallet. This is a custody account. Things like that. So you can have another layer of on top of knowledge, right, that you can incorporate. So whether it's a transfer from the hot wallet of Binance, that's fundamentally different than when it's a transfer from my address, and should have a different weight in any model. So avoid, for the most part, building crypto machine learning models that rely only in anonymous blockchain data set. Those are a waste of time. They don't generate any alpha that is meaningful, and try to invest more time on building models that incorporate domain knowledge. Like, for instance, we're working on things that factor in flows in and out of exchanges. We cannot claim that we have great results yet, but there is a domain thesis behind it, right? When you see a ton of money going into an exchange, could mean something when you see a ton of money going out of an exchange. So there is a thesis behind. It's not that we're looking at a blind data set and trying to extrapolate some crazy predictions. So reason number 7, factor theory, that has long been considered one of the cornerstones of quant finance, just doesn't work in crypto, like flat out. So if you read the traditional Fama French factor theory 3, 5, 7, factors, value, carry, volatility, and others, most of those have zero impact from what we can say, empirically speaking, in terms of crypto, which is more interesting. Is that there is really not a clear, some of these factors cannot even be clearly defined in crypto assets. Like, if I tell you what is value for Bitcoin, what is it, right? There is no balance sheet, there is no, so there are multiple ways to define that, and none of those has been really tested or validated. So factor theory, there are funds in Wall Street like AQR that are fundamentally, the factors is all they do, right? And the dozens of billions of dollars under management for doing this stuff. And in crypto, those strategies don't work at all. From what we can tell, momentum, volatility are some of the ones that seem to have some weight, right? But nothing very clear yet. So one idea that we think is interesting is factors could be used as a risk hedging mechanism. So you can see strategies that use risk hedging based on volatility or momentum. That's interesting. But also crypto deserves its own factors, right? If you cannot define value, well, there are other factors that are specific to crypto, DeFi, momentum, definitions of carry, or things like that. And one thing that we'll recommend against is to try to just take factor-based research and quant models and try to adapt it to crypto. I don't think that stuff works. So this the reason number 8 is a debate that we have regularly. That is this idea of simple model versus complex models. So many quants will argue that simple models are based on a few parameters, are better because they're easy to understand. So you can see the model is making a prediction, you can know why it's making a prediction. And that's a lot of the majority of quant funds, even in traditional capital markets, that's how they operate. There is a new school of thought that is more evolving around the deep neural networks, deep learning space, that thinks the opposite, is that more sophisticated models, the ones that are breaking records, the ones that are being used by Google, Uber, Microsoft, Netflix, those are more efficient in capital markets, because in the same way that they work for image, computer vision, speech, they can uncover nonlinear relationships between many variables at the same time and be more efficient. The problem with that is that you don't know what they're doing, right? They're like black boxes. So in our experience, most crypto is too inefficient of a market for simple machine learning quant strategies. So if you're playing with things like decision trees, linear regression, Bayesian networks, things like that, they're very vulnerable to price fluctuations, spikes in volume, and they're very fragile in that sense. The deep learning school that is new, right? Even for traditional capital markets, we think it has a bigger promise in this space, and this is where we spend a lot of our time. So deep learning, we think, is more promising in this area, and it's a recommendation that you spend. And there is also a ton of more research coming out of research labs, right? If you follow quant research, there is 80% of the 70 of the publications any given week are about applying this new set of techniques, right, and experimenting with this new set of techniques. So you can take advantage of that mind share. But if you're going to do that, you should invest in what is called interpretability or explainability tools, things that can look at a neural network and say, look, help you understand why it's making certain decisions, right? Which is not trivial. This is a space that is just evolving now in the deep learning space, and the tool set for understanding these things and debugging them and all that is very nascent. So it's painful to use. And if you're going to use simple quant-ML models, keep it to very constrained scenario, market making, high frequency trading, things like that are very, very narrow, right? That they don't need to deal with they're not exposed to many market fluctuations. That could be, that there is definitely a play there. And as crypto become more efficient, then a lot of these models will have a lot of a more stronger presence. Then basic quant infrastructure is our point number 9. So this is more macro, let's say. So crypto is a new asset class. Quant infrastructures in crypto are very, very new. So things such as portfolio management, risk mitigation, and things like that, they're relatively nascent in the crypto space. And data and machine learning infrastructure, that is what we do, is also very, very new, right? So when you're looking at a crypto hedge fund in the for that is working in quant strategies, the infrastructure underneath is an important aspect to about what could make it successful. One mantra that we use internally is that we believe better infrastructure beats better strategies in the long term any day, right? So if you have a good infrastructure for data, machine learning, you can create more and more strategies. If you have the genius strategy and no infrastructure to recover from market fluctuations and things like that, you're definitely exposed to a lot of risk. So definitely invest in data infrastructure and leverage a lot of the tool sets and open source frameworks and things like that that are out there. And then my last point, and we're on the half an hour mark, is talent, right? That is often overlooked. And in the crypto space, there is still a lack of quant talent, right? There are buckets, right? But it's very it's very narrow, and still you're not seeing the big quant funds playing in this space yet. And a lot of the quant people don't understand crypto. A lot of the crypto traders, they don't get statistics and quantitative models yet. And if you look at the AUMs of quant hedge funds, they're relatively small, right? So all that is conspiring against the evolution of the space. We don't have any genius advice in this area. What we do know is that in our experience, machine learning experts and mathematicians makes better quants in this space than quant themselves. So we invest a lot in bringing good minds in the machine learning, deep learning space, and having them learn the crypto dynamics of the market instead of trying to bring quant people into the crypto space. Now, having said that, despite all these challenges, right, there is the future for quant in crypto. We think is super bright, right? Crypto was born in the golden era of machine learning and deep learning. The reason we're having this conversation is because a lot of these techniques are possible. Today, there is a ton of open source frameworks and platforms that allow you to experiment with things that were not possible just a few years ago. And by data standards, crypto might be the richest asset class in history, right? In terms of the number of records it generates in blockchains and DeFi protocols and things like that. There are movements that are making crypto like an extremely data-rich asset class. So there is a lot of opportunities, but also a lot of challenges. So just to summarize this real quick, I'm going to announce the next webinar. I'm going to go straight to questions. So quant ML strategies are definitely a feature of crypto trading. but most of the traditional stuff that you see in quant research doesn't apply to crypto, and there are very strong challenges. I enumerated 10 of them. And despite the challenges, we think that the universe of crypto and quant, that intersection, is definitely worth pursuing, and there is a ton of opportunity there. 3 weeks from now, December 9th, my colleague Lucas Otomoro is going together. We're all experiencing the boom in the bull market in Bitcoin in particular. So we're gonna do a session about providing a ton of analytics and insights about Bitcoin and Ethereum against traditional capital market. Crypto and fan stock, crypto and commodities ETF, and stocks that are doing well with COVID, renewable energy stocks. How about Tesla, Nikkei 225, the FTSE, like all this type of analysis and thesis that we're hearing in publications and all that. We're going to try to bring together a very data-centric perspective of this and show you some very unique insights. The link for the webinar is in the chat window. So go register. This is our last webinar of 2020, and it's gonna be awesome. And hopefully by then we'll have an entire section of the Into the Blog website dedicated to this thesis. So I somehow managed to ignore all the questions while I was doing the session. So let me start going by one by one. Mariano Gonzalez asked if we have an API. We do. Is for our partners and customers, but just send me a note and I'll point you to the documentation. Peter Diotri asks, how does technical analysis and trading robots fit into the picture? I mean, trading robots is just an implementation of some algorithmic trading strategies and can certainly be applied to quant. In terms of technical analysis, it does play a factor. Many quants are opposed to technical analysis, and I think it as a pure technical strategy, or follow this to do that and all that. We think a lot of those strategies are questionable, but as a way to take a prediction from a quant model and better judge an entry point and exit point and things like that, technical certainly have a place. And there are many people that have experimented with creating quant models just based on inputs of technical indicators. So for sure has a place. Cool stuff. Okay, so this guy said, can you share the slide deck? Yeah, absolutely. So after tomorrow, I think I'll post it in the Into the Blog Medium blog, and it will be available in our slide share and resource pages as well. Fernando Villar is asking, how does walk forward analysis contribute to some of this quant strategies? A lot. I mean, it's as any strategy. Back testing is one thing, but you always have to do forward simulations and things like that. So as a mechanism for trying to forecast how your strategy is gonna look in perform in the market, a lot of those strategies are super valuable. A couple of people saying thank you, so thank you back. And I think that's all we have. So I'm not sure if you guys have any more questions. Questions going once, questions going twice. Cool. Well, thank you very much for joining this webinar. I hope to see you 3 weeks from now. It's gonna be super cool. So go and register now, and thank you again very much. I hope for joining. I hope you enjoy the content and the discussion, and the materials will be online very soon. Thank you very much.